Okay, we're back. Tito and Davie. And today we're going to be talking about, let me have a look, accounting myths versus facts.
Here you go. The painkillers. Mr. Tito is having a headache, so we decided to get him some medicine.
Yeah, oh my God.
Cheers, mate.
Cheers.
Cheers, cheers. So we're doing top accounting myths versus facts while drinking.
All right, so we're going to start with the first one. So, my business is small, therefore I do not need an accountant. Davie?
I guess that could be a myth and a fact. Like, it just depends, right? Just because you got a small business doesn't mean that you don't need an accountant. If you have absolutely no bloody clue on what you're doing, then you probably do need an accountant. I find that a lot of people that say that end up getting their taxes wrong. They either pay too much tax or they don't pay the right amount of tax, or they just don't do their taxes at all. So, you know what, that's probably a myth. I think most businesses, especially in Australia, need an accountant. Do you know what you're doing with your taxes?
No.
No clue.
No. Hence why I came into his office asking about that $1,080 tax refund.
Yes, I think most businesses, especially in Australia, so there are some countries out in like Singapore, I heard, and UK where the government actually does your own taxes.
Okay.
So they do the taxes for you because they've got the data feed to go straight into their tax system.
Yeah.
And they lodge the taxes, and all you need to do is just put in your tax deductions, that's it. But if you're running a business, you have to deal with GST, you have to deal with payroll tax, you have to do superannuation, you have to deal with wages, income tax for your employees, and then you've got something else called payroll tax, which might not be work. Then you've got land tax. You want me to keep going? FBT, French benefits tax.
That kind of leads me to my next.
Okay. So that's why you need, so it's a myth or fact?
Yeah, so it leads me to my next one.
But first, it's a myth or a fact?
Well, I reckon it's probably a myth at this stage.
Yeah, I reckon so. Okay, cool.
All right, so it leads me to my next one, which is processing payroll taxes or self-employment taxes are only for corporations, big businesses, or businesses with employees.
Maybe true before, because back then, I would say that when I first started in accounting, about 14 years ago, you didn't need to do too much when it came to payroll.
Yep.
You didn't, you just need to give your employees a group certificate and make sure that the taxes are paid by a certain period. You can do annual wages, or you can do quarterly or monthly or weekly.
Yep.
It just depends on the business. So it wasn't that much back then, but now there's something called single touch payroll, which basically means that it's not what the word...
Well, how many touches are there?
Yeah, there's more touches than one. So basically, single touch payroll is basically a reporting method where you report to the government on all your payroll payslips.
It must be single touch for them because we do it.
Yes, it's single touch for them, but not for us, because we require to put in the payslips, and then we have to set it all up, and then we have to lodge to the government every single time we do a payslip. So it's single touch payroll for every payslip.
Yeah.
So maybe that's what it means, but it means that basically every small business needs to do it. And a lot of businesses say, well, I'm a closely held business, so no, I don't need to. Do you know what closely held means?
No.
It means that all the employees are family members or associates, like wives or husbands. So therefore, we don't have to do payslips. That's not true at all. From the 1st of July 2021, they basically said everyone needs to do it.
Yeah.
Even if you're a small business, even if you're closely held, even if you're a micro business, as long as you have an employee, you have to lodge single touch payroll.
So does that mean it's a myth or fact?
Myth.
Myth, okay.
Nearly said fact just now.
I know. I had to answer it for him almost. All right, so next one, payroll. Payroll software with payroll calculations and tax payments are all I need for payroll.
No, that's not correct, but because you need to work out annual leave, you need to work out what type of pay you're paying. So apparently single touch payroll, we'll bring that word again up, which is a new reporting standard. Moving forward the next year, the year after, the ATO is not wanting to just know how much wages you pay and how often, and how much tax and how much super. They also want to know what type of wages you're paying. So are you getting maternity leave? Tito, are you going to get maternity leave?
Probably not.
Yes, or if you're getting a bonus, commission.
Yeah.
Or if you're getting annual leave, sick leave, all that stuff like that. So payroll softwares are more and more becoming the new compulsory software that you need.
Okay.
So a lot of businesses are not using a accounting software or payroll software, and right now it's going to be phased out. So you got to jump on something.
Yeah. So it's a myth. Okay. Put it simply.
Yeah, pretty much. Cool.
Okay, so next one. I don't need separate bank accounts for business and personal expenses.
So what's your answer to it?
You need a separate.
Yeah, separate. All right. Stop trying to do everything in one bank account.
It gets convoluted.
Gets messy.
Right. Your accountant's got to look at it and be like, why is your Netflix subscription and your suppliers invoicing on the same statement?
Yes,
Yeah.
exactly.
It just makes it a lot harder to track.
Yeah.
Yeah.
And it's not. And a lot of people think, oh yeah, that's just my accountant's problem.
Yeah.
Yeah. No.
No, it's your problem.
It's your problem.
It's definitely your problem.
Yeah. Because I'm just gonna increase my bill. So, or more than likely, your accountant's just gonna hate you. They're gonna just not like you ever, and just keep constantly. Do you guys ever notice that the time where your accounting fees always go up annually? It's probably because your accountant doesn't like you, and it's probably because you're a mess. So,
Keep it separate. Keep it separate. Sorry.
Yeah.
And it's good to have that attached to your accounting software. Just makes things a lot easier.
Yep. So if you're setting up a business, create a new business bank account, and do not create it under your name if you're running it through a company. Create it under the company's name. I get that sometimes as well. So clients just set up a business bank account thinking that they can just use their own personal name.
Yeah.
It's not right.
The other thing too is that the ATO might look at you and investigate and potentially audit you, because what they're seeing is convoluted numbers and transactions in the same bank account.
Yeah, exactly. So I had actually a horror story where I had a client that was trading through their personal bank account, cash deposits in their personal bank account, running a proper business, but their business was a cash business. So they thought he was doing some sort of money laundering stuff, and they just canceled his bank account.
Yeah.
And what happens then?
What happens then?
It's not running a business anymore, not making any money. So yeah, his business got halted for about a good 2 weeks because he had to set up a separate bank account from somewhere else.
No.
Yeah, so definitely a myth.
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 Okay. The next one is 50% of all money earned is for taxes. Well, it really depends, really. Well, it really depends, right? So, as sole traders, as you would imagine, sole traders or companies, etc., they usually prepay their taxes, right?
Sole traders, yeah, if you've paid your taxes last year, yeah, you prepay your taxes.
So, you don't know how much you're going to earn from each month to month, right? You might make a loss in one quarter, you might make a profit in the next quarter. It really depends.
Yeah.
But I think there's a benchmark in terms of how much you set aside.
Yeah, so what I told my clients is about 30 to 40%, not 50. And that 30 to 40 is on your net income, so net profit.
After your expenses.
Yeah, so it's not your total income that you received. So if you get like, $1 million deposited in your bank account, it doesn't mean that 500K is going to the government.
Yeah.
It means that after all your expenses, then probably about 30 to 40% is going to your government. If you don't make any profit, then nothing is going to the government.
Exactly.
Yeah, but you might get audited after 3-4 years if you never make any profit.
Yeah.
Yeah, so I think that's a myth as well.
Yeah, it's a myth to some extent. I think at the very most, it's what you'd say, 45%?
Most.
Yeah,
most,
that's if you're a sole trader, you haven't had the conversation with your accountant to figure out what your business structure is going to be. Yeah,
there's a lot of ways to reduce your tax, man. There's you can structure it a lot better. We talk to our clients about setting up companies. We talk to our clients about setting up, putting money into super. We talk to our clients about using a trust. If you're paying about 50%, then one, probably got to look at finding another accountant, right? And two, if you're paying too much taxes, then it also means that you're not structured right. So figure out how to structure yourself better and speak to the right accountant.
Yeah, okay.
Or Box Advisory, or Tito.
No, speak to me. Okay, next one. So waiting until tax time to speak with your tax accountant. Wow, this is something I get a lot as the guy who's the first point of contact for new clients that we speak with, new I guess anyone that's running a business or even an individual, they wait until tax time to have a chat with us. Davie, you want to elaborate on that?
Yeah, this one's like I wouldn't say it's a tax or a myth. Like obviously speaking to your accountant is the best. It really depends on your situation though, because if you speak to your accountant a lot, what generally normally happens is they're going to just constantly send you bills. Because we accountants, well, not me, not my firm, but most firms charge on a minute by minute basis. Like, so if you're spending like, you know, half an hour on the phone with your accountant, most likely going to expect a bill for 100 or 200 bucks. So it's quite a lot of money. So I wouldn't recommend, it just depends on your situation. If you're running a really big business, you're turning over quite a fair bit of money and you've got a lot of employees, then it's probably a good idea that you speak to your accountant on a weekly, maybe monthly basis. And it depends on the arrangement with you have your accountant. But if you're a personal tax return, you've got a wage, a salary, and you've got some tax deductions that you claim when you do your personal tax return, you probably don't need to speak to your accountant very so often. What we normally tell to our clients is that when there's a big transaction that's happening, so if you're buying a property, if you're selling a property, if you're investing in shares, if you're going to put a lot of money into investing shares, so not that you're buying like, you know, $1,000 of Coca-Cola shares or something like that. That's not that much. Look, it's not going to be a big deal. But if you're making a big transaction and it impacts your taxes, it impacts what's going to happen in the future, and it impacts your family or your superannuation, then it's a good idea to speak to your accountant when that happens. Yeah.
Okay.
Cool.
So that would be, it depends really.
Yeah, it really depends. It's not a fact or a myth. I would say it just depends.
This one's actually pretty good. All startup costs can be deducted immediately.
All right, let's do it. All right, next myth or fact.
Next statement, really.
Yes, next statement, guys.
All startup costs can be deducted immediately. Davie?
So this one depends if you're a business or if you're running, like you set up a company or a trust for investment. If you're branded as a business, then yes, you can deduct it immediately. So there is this rule, I forget the legislation, sorry, I'm not a bookworm, I can't remember the legislation off my head, but it's basically allows you to claim all startup costs if you're running a business. But if you're not running a business and you are investing in shares, property, passive income, then you can't claim it up front.
Okay, so it has to be like a primary source of income.
Yeah, basically, it has to be like you...
Besides employee.
Yeah, you have to legitimately be running a business. And a form of running a business is basically your...
Really comes down to that PSI, PSB stuff, right?
Yeah, you're running an activity to be... you're running some sort of activity in the hopes of making a profit. Yeah. That's what it is. I know it's a bit weird, right? Like...
So how about those guys who are like personal service income guys?
Yes, because they still brand it as a business, yeah. So setting up a company can be claimable.
Okay.
Yeah. So yeah, even if it's not claimable straight away, you can still end up claiming it. So if you, for example, set up a trust and it costs you 2.K to set up the trust, and you buy shares with that trust, and then you invest and you start making profit, you can't claim the setup cost of the trust, but you can claim it if you ever sell the whole trust, like to someone else. Like if you sell the whole, the assets. Yeah, so you can claim it because it's in the form of, it's related to the actual setup of buying those shares. Yeah. So when you do sell those shares, you can claim, sell the whole vehicle, like the trust and the shares, then yes, you can claim it then. Okay. It's a bit weird.
So what would be the short answer to this?
Fact if you're running a business.
Yeah.
Myth if you're running an investment entity like a trust or a
passive income.
Yeah, passive income type of entity. Cool.
Cool. All right, that was interesting.
It's different, eh? What do you think?
That was sarcastic.
Okay.
All right, so next one. I think this one's pretty good. I get this a lot. I've put my company branding on my vehicle so it can be written off against my tax. True or false?
That's false completely. Like just because you put your branding on it, it doesn't mean that you can claim it. It depends, right? First things first, is it a work vehicle? Is it classed as a work vehicle? A work vehicle that's 100% business always is anything that carries more than a ton, or if it's a motor vehicle that's more branded as an equipment, which is like a van, a ute, or a truck. Those things there, wherever you put your branding or not on it, it's 100% tax deductible for business.
Oh, okay.
Yeah, but when you're talking about a normal family sedan like your Subaru Impreza or your Toyota Camry or your Mercedes, those cars there, just because you put your branding around it doesn't mean the whole thing is tax deductible.
Yeah.
The ATO relies on a logbook method, which means that you have to keep a logbook for 13 weeks on how much you travel for work and how much you travel for private use. Once you work out the percentage of private use versus business use for those 13 weeks, you average it, and then you work out what the percentage is for business use, and you times that by how much expenses you spend on the car. So it's not all tax deductible just because you slapped your brand on it.
Yeah.
Yeah.
Right.
Yeah.
So put it simply, logbook method, and the car has to be a certain type.
Yeah.
And a certain weight.
Yeah. Basically. Cool.
All right. Next one. Okay, small businesses don't need specific accounting and bookkeeping systems for now. So these are mainly talking about startup businesses.
10 out of 10 of my clients have a software. Whether it's a spreadsheet, a basic spreadsheet, or whether it's an accounting software that's cloud-based, they all have one.
Yeah.
Because how the heck are you supposed to know how much money you make?
That's right.
And how heck do you invoice your clients?
That's right.
So you need some sort of software. Just because you're using Excel doesn't mean that that's not a software. That is a software. Last I heard, Excel is a software.
It is a software.
So technically, you're using some sort of software.
It's
right?
a software. Yeah. Obviously, you try to keep the costs low when you're starting up a business, but it'll take you a very long way if you decide to purchase any accounting software. There are some accounting softwares out there that are quite cheap on a monthly basis.
Yeah, like Xero is Xero is okay, 20 bucks, that's the minimum.
And then there's Rounded accounting is really good.
About 20 bucks
That's
if you're a
about
sole trader business.
Yeah, go for the 25, don't go for the cheaper option. Reason is, the cheaper one would not include, it won't spit out the profit and loss statements. It won't allow you to connect your bank account to it as well, which is very important. And I think there's another one, and it won't track your GST.
Yeah.
Okay.
And that's the biggest problem. Like a lot of businesses, when they start off, they just like, I don't know if they get the wrong advice, but I always tell our clients to get on something. Whether it's a spreadsheet or whether it's like a cloud-based, preferably cloud-based, spend the $25 a month. It's not that much money. Look, mate, it just basically means a coffee a week. That's it. One coffee a week that you need to cut off.
Basically.
Yeah, like once you cut off one coffee a week or one drink a week.
That's one expensive coffee.
Yeah. So there you go, guys. Just get an accounting software.
Accounting software is important.
Do it.
Do it. All right. This one's actually interesting. Hospitality business owners don't have to report their tips.
Not true. Did you think otherwise?
Yeah.
No, not true. Not true at all. They're supposed to report it.
Oh, really?
Yeah. I don't know how many people do report it, but yes, they're supposed to report it.
Okay, so that kind of answers two of the other. There's another one where if I'm paid in cash, when I'm paid in cash, I don't have to record it. So we're gonna answer two of these, okay?
Okay, let's answer that one. If you are paid in cash, do you have to report it?
Yes.
Obviously, guys.
That's, yeah, very obvious.
Just report your cash. Income is income. Whether it's in the form of cash, whether it's a form of, bank transfer, whether it's a form
Just
of...
report it,
Yes.
okay? Just report it.
Even if it's a form of anything, you have to report it. So if I give you this drink in a form of you working for me, you have to report it. I don't know how that works, but...
No, I don't know how that works either.
I don't know, but the government basically said that if you receive anything in the form of something like else, then they charge the market rate. Like you should be technically working out what the market rate is and then adding that to your tax return. Look, it's not gonna be that much anyway. Like you're not gonna receive, a truckload of alcohol in the form of your wage. So most likely report the cash because it's very easy to figure out how much it is.
Yeah, put it simply, just report it.
Yeah.
All right, so next one. I don't have to pay superannuation because I employ contractors registered with an ABN.
That is a myth. Yeah, so I definitely recommend you guys speak to your accountant about this. So the rule when it comes to employees versus contractors in the tax office So the definition of an employee versus a contractor in income tax rules versus superannuation laws are different. You can be branded as a contractor.
Yep.
And you don't have to pay the taxes for your contractor as an employer. But when you are a company or a business paying a contractor in your superannuation rules, you still have to pay super. So you can still have to pay your contractor super.
Yeah.
It's weird. And the rule is basically that they're providing labor services. If they're providing any sort of labor services in superannuation laws, you have to pay super.
Okay.
So it's a bit weird and it's very hard to work out.
Yeah.
So the best bet is to not deal with this, is to make sure that the person that or the contractor you're contracting out services to is a company, because you can't technically pay superannuation to a
company
because it's not an individual.
Gotcha.
But there are cases in different industries like laborers, construction, might have to deal with superannuation, their employer. So it's a good thing to look into that, especially if your contractor is providing a labor service to you on an hourly rate.
Okay.
If they are, then most likely there's superannuation involved.
That's interesting. Yeah.
It's different, eh? No one kind of knows this. It's always easily forgotten.
Yeah, okay.
That was a good one.
All right, so we got about 4 more left, right?
4 more left.
Yeah, but 2 of them will be just together. I think they fall in the same area.
Yeah, okay. Let's do it.
All right, so I think we'll talk more about properties, right?
I'm getting a bit drunk anyway, so I need to finish this soon.
I'm done for the day. If I develop and sell a property, then I get 50% capital gains tax discount.
Developing and selling a property means that you purchase land or a property that's run down, and then you either knock it down, renovate it, or you buy empty land and you build on it.
Yeah.
And then you get it, like you go to the council, get DA obviously, and then you get a builder to come in, or you build it yourself, and then you sell it off as new residential property because it's new. If you do that, then you're not really running an investment vehicle. You're not investing for passive income. You're actually developing and running a business. It's a profit-making scheme. So if it's a profit-making scheme, then you don't get taxed on capital gains.
Yep.
You get taxed on your income tax rate.
Yeah.
Whether it's in the company, whether it's in your trust, or whether it's in your personal name.
Yeah.
So you get taxed on the marginal tax rate if it's in your personal name, meaning that 0 to 45%. And you also get hit by GST.
Ooh.
GST is 10%. So you get like something called a GST margin that you can calculate. But basically you also have to pay GST on the sale of that property, because that property is a new residential property. It's a product and you're running an actual legitimate business. So therefore the tax office actually taxes you quite a fair bit. It means basically you're not really doing this for investment purposes.
Gotcha.
Yeah, it's actually a business.
All right, so that leads me to, well, I kind of answered that, right?
Yeah, there's one more thing. So how do you get it to 50%? The only time is if you own that property and you don't sell it for the next 5 years. So you develop it,
Yep.
and you hold it,
Yep.
and you rent it out for the next 5 years. The rule is with the ATO is 5 years.
5 years.
So if you sell
For
it within,
investment properties.
yeah, for it to be an investment property, and then when you sell it after 5 years,
Yep.
you will get the 50% capital gains. Even if you developed it, knocked it down, rebuild, or you built from scratch.
Okay.
But it's hard, man. Like, how do you hold a property for 5 years when you can't afford it, maybe? Because it costs a lot of money to build.
That's true.
Yeah, so, and you might get a buyer come in and say, oh, I want this property, and they want to sell, they don't want to buy it now, they don't want to wait 5 years.
Yeah.
Yeah, so it doesn't work in real life sometimes. But yeah, the rule is the ATO says that after 5 years, it's considered not a new residential property anymore. So therefore, when you do sell it, it's 50% discount you can get.
Okay.
Yeah.
So that leads us to the next one, right? If I move into an investment property, then sell it after, it's 100% tax-free.
Oh, mate, I get asked this question so many times. The answer is no, it's not 100% tax-free. The way the calculation works is, let's just say that you owned the property for 5 years. First 4 years, you rented it out, and in the last year, the 5th year, you moved in, and then you sold it off. So when they moving in, they trying to claim the main residence exemption rule, which is basically you don't get taxed on your home. But the way it works is that it doesn't bring it all the way back to when you originally owned it. It just starts it from when the day that you elected to be your main residence. And the only time you can elect it to be your main residence is obviously when you moved in.
Yeah.
So you only get to claim 1 year out of the 5 years that it's your main residence. So 1/5 of it is exempt. 4 out of the 5 of that property is taxable.
Okay.
But you still get the main residence, so you still get the 50% discount.
Yeah.
Yeah, so you get a 50%.
Still something.
Still something, but you don't get it all 100% tax free.
Okay. All right. So to put it simply,
Myth.
myth. Okay. Oh geez, this is something I get all the time. My business should be structured as a company to minimize my income tax.
What do you reckon?
It's a myth.
Yeah.
Yeah.
Yeah, because you know that rule that we always tell our clients?
Yeah, the PSI rule.
Yeah, PSI, personal services income, which basically means that you can't be an employee and then like set up a company and then get taxed at 25%. It's not possible. Like, you know, there are strict anti-avoidance rules that prevent you from doing that.
This is a very, very common situation for us.
Yes, we get this question pretty much every single day, maybe?
Yeah, almost.
Yeah, almost every single day.
From one particular industry.
I'm not gonna name names.
IT.
Yes, IT is a very common one with personal services income.
Just straight up IT, mate.
Mate, IT guys, mate, you guys are just too smart for your own good, mate, trying to ride the system. But look, you can be a legitimate business and set up a company. You just can't be an employee, get paid as an employee from one source of income.
Yeah.
And monthly amounts that are exactly the same for the next 10 years of your life, and then just set up a company, because that's not, you're not running a company.
You're not.
Not running a business.
You're just trying to reduce the tax.
Yes, and it's so obvious.
Yeah.
So there are strict PSI rules and anti-avoidance rules you've got to follow. We're not going to go into it. We've done videos about this before.
Many,
and we've talked about it so many times.
endlessly.
Tito's probably sick of it by now.
Very sick of it.
Yes. So please, guys, that's definitely a fact.
All right.
It's a fact.
It's not a
It's a
fact.
myth. It's a myth.
I just said,
Yeah.
that's how sick of it I am. All right, last one. So I can't use my self-managed super fund to help my business.
Yeah, you can't. Like, you can't be taking money out of your super fund to invest it in your own business, because it's considered in-house assets.
Yeah.
It's basically saying that you can't go benefit from it personally.
Yeah.
So a self-managed super fund is basically that 10% or 9.5% super that you've been paying, your employer's been paying to your retirement fund. That is actually utilized when you retire. And once you retire, you get to take money out because you're not going to have any more income.
That's right.
So the government's trying to force you to save, but they're not going to allow you to go and save and then take that money and then invest it back into your business.
Yeah.
It's not allowed.
It's not.
Yeah, so you're going to have like something called a contravention in your self-managed super fund, and over time they could just find you a lot with your self-managed super fund. Then you're going to have contravention reports, and they could pretty much deregister your super fund, if anything, or force you to close your super fund, and that would cost you a lot more fees as a result.
Ugh.
Yeah, so definitely don't do that.
Not a good idea.
You can take money out to invest in other ventures, but nothing to do with your business.
So yeah, passive income based.
Yeah, basically, and definitely speak to a financial planner.
Financial planner.
Yeah.
And you're an accountant.
Yeah, and your accountant and a lawyer.
And
you need to get a
lawyer, solicitor. Basically any professional services.
That's it. How's your headache now?
Better. Drink.
All right, cool.
All right, so to wrap it up, thanks for tuning in with Davie, the friendly neighborhood accountant, and Tito.
You want to do that again? That sucked.